So now you have determined the size of your position. You know your stops and target levels and have entered the market. But how are you going to choose to manage the position size as the trade develops? There comes the trade management, and the same refers to how we deal with the position once we have entered. And this trade management must be part of your system. You must know in advance what to do on every single situation, what kind of actions you must take under different scenarios. All of these must be well thought out because you need to make sure every decision is taken in best interests. Now, good trade management can turn a bad situation into a slightly better one and a good situation into a perfect one. And learning how to properly manage your trades will continue to put the odds in your favor. Now, the most important trade management techniques are averaging, which is adding to a losing position, pyramiding, and that's when adding to a winning position, and scaling out, which is taking partial profits. Averaging is quite a risky technique, and if used, should be applied carefully with a well-developed plan. This averaging must never be done impulsively or in an attempt to rescue a failing trade. We need to be really careful when using this methodology. We must avoid using this technique just because we want to improve our average entry price, and incorporation of this methodology has to be part of a well-developed plan. Now let's take a scenario. The system of a trader signals a short trade. However, there is an important resistance level a few pips above the current price. So there is a possibility that the market goes up a little further to test the resistance level. So the trader opens a short position and decides ahead of time that if the market goes up to strike the resistance level, he or she will add one more lot. However, if the market breaks such resistance, then all positions will be closed right away. Now, under these circumstances, averaging down is acceptable because it was part of a well-developed plan. On the other hand, if you just want to average down because the price has gone against you, you are only making your losing position larger. Now, this pyramiding is just the opposite of what you do when averaging. As the trade goes in favor, the trader keeps adding positions. Now, this technique is seldom used by traders because it acts against human natural reasoning to lock some profits. Understand that once you are in a trade and the same goes in your favor, then it has a higher probability of success. If it goes against right away, then it has a higher probability of failing. And this adding position randomly will definitely have disastrous effects on your trading account, and you must have a well-developed plan. Now let's understand how this pyramiding works. Say a trader decides to go long in USD JPY at 108 with a stop at 107, and the target is determined to be 113. Now there is a minor barrier before 113, say a resistance at 110. Now this trade starts to move in favor, keeps going up and breaks resistance of 110. So the trader adds to this winning trade and squares off completely at a predetermined target of 113. Now keep in mind that increasing the trade size at higher prices will also increase your average entry price, exposing you to a potential loss even during a normal market correction. So pyramiding must always be done using smaller positions as the market goes your way, and also when original stop has got trailed to break even. And now this scaling out. It's a common technique where traders take partial profits when a certain major level is reached. This should be calculated prior to opening the trade, and need to be strictly followed in order to avoid fear, greed, and other psychological issues that may affect your decision. Now let's understand how scaling out could work. And continuing with the pyramiding example, say the trader bought 2 standard lots at 108 and went on to do pyramiding at 110. So now the trader is having 3 lots, and there is a stiff resistance around 112. So the trader takes partial profits, squaring of either 1 or 2 lots at 112 and square off the rest on reaching predetermined target of 113. Keep in mind that if you want to boost your profits, then do not do this randomly or without a definite plan. All trading decisions should be part of a logical approach before you enter a trade and not driven by emotions while the position is open.